Hey, welcome to this video on day trading setup that used to work. In fact, this was one of the first day trading setups that I was taught. It's a traditional setup, and I see that it's still taught a lot, and I find that it doesn't work anymore. And basically, here's what it is. So this represents YH, that's yesterday's high, and YL is yesterday's low. So the teaching was, all right, when we're looking for the market to decide on whether it's going to be bullish or bearish for the day, you look for it to break out of the range of either above yesterday's high or, of course, conversely, below yesterday's low. And it makes sense because if it doesn't break above yesterday's high or below yesterday's low, well, then when you look at it on a daily chart where each bar represents 1 day of price activity, it's going to be an inside bar. And that's fine, and that happens sometimes, and we just get very neutral days. So the thinking is, well, if we're going to really get a market moving on an intraday basis where we can really day trade something that's just not going to move sideways all day, we want this thing to really move up and break yesterday's high or break yesterday's low. Unfortunately, this is a type of breakout trading, and I don't personally find that breakouts of support resistance levels work very well in and of themselves. Now, you will get breakouts, but I trade them very differently because we get so many false breakouts is the point. So many false breakouts now. So everything's looking great. Market's cranking right along. Okay, and if you said I'm going to trade the breakout of yesterday's high, not doing too bad, right? You're making some money. And if you use some good money management, you'd probably have a profitable trade there. But then, let's see, it starts coming back down, comes back down, comes back down, comes right back under yesterday's high. So as you can see, the green bar, yesterday's high, or the green line, I should say. So it did get above it. It did stay above it. Could have been made a little bit of money. But did it create a bullish day? And that is the thing. No, it lasted for a couple of hours, and a lot of times they don't even last that long. So if you're looking for, oh, this is going to be a bullish day, you're going to not be a very happy puppy. In fact, it goes all the way back down before the market closes. It actually goes all the way back down and breaks yesterday's low to the downside. So it completely reverses, goes all the way through yesterday's price activity, and goes down below yesterday's low. And so then you get a breakout down here, and then again you could say the same thing. Well, great. Okay, that didn't work out too good. Worked out short term, not long term. It didn't turn into a bullish day, in other words. Well, maybe it's going to be a bearish day after all. So when we break yesterday's low, alrighty, comes down, and then comes right back on up. It's like, okay, getting kind of frustrated now. And then, as you can see, it just continues to go. It goes back above yesterday's low and goes right back into the middle of the range. And guess where we close? We close in between yesterday's high and low. So it did not turn into, after all was said and done, it didn't turn into a bullish day or a bearish day. We had little breakouts to the top, breakouts to the bottom. Both essentially failed, and could have made a little scalp on them, I suppose. But it's not a good technique for determining whether the day is going to be a bullish or bearish day. Now here's another example. And in this one, it's a little worse. The last one wasn't too bad. This one's not too good. So we get above yesterday's high, and then we come right back down. So this one didn't last long at all. So that was just pretty disastrous. In other words, when we take a trade, we want to get as much reward out of it. We want to get as much movement out of it as possible. We don't want just little breakouts and then it retraces back down. And so the point is, it goes back to the basic premise of professional trading, keeping your losses small, letting your winners run. So these breakouts are not creating situations where we are allowed to let our winners run because they're not following through very much. So here's another option. And the option is that instead of looking for breakouts of yesterday's high and low, looking for the breakout of a different range. And so here's yesterday's close, and here's your pivot point or your central pivot based on floor trader pivot formula. And what I do is, now see, if you're looking at for breakouts of previous day's high or low, you're already in an extreme, right? So the market's already made a move and you're looking for it to really make a big move. And sure, sometimes that happens. And if it keeps going in your way, which sometimes it will, then that's great. It's just I don't see it happening as much as it used to. So I want to get in early. Professional traders, we want to get in earlier. So yesterday's close is essentially what the previous day's market, after all was said, was done. All the participants decided, okay, this is what the market was worth, today. And so that's considered the fair value, if you will, from that day. If you want to look at, be super precise, then go ahead and look at the settlement. And the pivot point is kind of the same concept. That's your mid-zone, kind of the balance of power, if you will. And so I look at these two and I take them as a zone, as a neutral zone. Actually, let me draw that a little differently here. So draw it on the lines instead of on the data there. Okay. So between those two lines, I'm considering that we're in a neutral market. We're in a balanced market. Neither the bulls nor the bears have taken over. As opposed to waiting to break above the high, yesterday's high, to decide it's a bullish market, or to break below yesterday's low to decide it's a bearish market. So I'm going to make that decision earlier. So now that can improve my reward tremendously because, and even if the market doesn't move as much. So, well, let's just look what happens here. And so once we take a trade below, in this case, we started above yesterday's close, and that's right at the beginning of the market. Okay, so I wouldn't really trade any of this yet. I'd wait for it to get down below, outside of that balance of power. If you like to wait for, if you do like breakout trades, I guess you could take it right there. If you want to wait for throwbacks, which is a little safer, I think, then you could wait for it to retrace back here to the pivot point or the central pivot, and that could be an entry point. And then, so great, now it goes down, down, down. Well, see, we've already made some decent money now because there, the red line is, I don't know if you can see that. That's yesterday's low down there. And as it continues to go, let's see if it breaks yesterday's low. It actually does. All right, but see, if we waited, this is the point now, we've already made some good money because we got in based off of the mid value or the ending value of yesterday's market instead of waiting for it to reach extremes. So even if it doesn't break yesterday's low, we're still making money. And if it does, then we're just making more money. And in this day, again, well, there you go. Breaks yesterday's low, it does. Comes back, there's your throwback. Goes down, stays down there a little bit, comes back up. But by the time we close, it comes back up above yesterday's low again. So this is pretty much a perfect example. And that is what happens more days than not. So just real quick review again, just to explain it. I like to, especially for intraday trading, which really that's what this is all about, is to use this zone here between yesterday's close and the central pivot or the pivot point as kind of a balance of power, so to say, and look for bull markets above it, bear markets below it, to look for that directionally. Now, no one's saying it's going to last all day. We're day traders. We don't expect every day to be unidirectional. In fact, that's very rare. We're just looking to have a good reward to risk ratio, and this gets you in earlier, and so it gives you a better reward to risk ratio. And then on those days when the market does go above the previous day's high, hey, you're golden. You're in way before the breakout traders. And when it does go below the previous day's low, again, you're golden. You're in way before the breakout traders there too. So I found this works very well and invite you to check it out. Put these levels on your charts and check it out for yourself. If you like this video, please understand that, sure, it's free, but if you got value from it, you actually have a moral obligation to pay it forward by clicking on the share button. In addition, if you're watching this on YouTube, please click the thumbs up icon below and leave a comment, because those comments really encourage me to create more free tutorials for you. I've got a special offer right now where I'm giving away one of my favorite trade strategies called the rubber band trade that has a very, very high win-loss ratio. It's a simple trade. I can teach it to you in about 26 short minutes. So I invite you to get that rubber band trade strategy absolutely free by clicking on the image in the top right corner of this video or in the description below the video. And if you're not watching it on YouTube, then there's probably a link below or an opt-in form on the side. Once you do that, I'll personally email the video to you with the rubber band trade strategy.